We are today starting an important concept in the corporate finance series, which is time value of money. Now, this is a very important concept in finance and also in the other context also. And when we are understanding about money, it's very important to understand what is the importance of money in terms of time. Now, why are we looking the time perspective for money? The time perspective of money is looked upon because let's assume that if I give a choice that if an individual has rupees 100 today, or will he take this rupees 100 tomorrow? So, if given a choice that you have rupees 100 today, either you have rupees 100 today or you take rupees 100 tomorrow. Now, you may not like to have this rupees 100 tomorrow, rather, you will prefer having rupees 100 today. Now, why do you prefer this? Why will you like to have this amount today rather than having the same amount tomorrow? The reason is quite simple. First, tomorrow may even never come because there's a big risk that after a year, what will happen whether a person will pay this amount or whether I will be getting this amount tomorrow or not, or tomorrow may never come also. So there's a big risk. That's the first part which is there. Second, if I have this amount 100 rupees today, I can consume it. I can buy anything. I can use it for my own purpose. And thirdly, if I have 100 rupees today, I can invest this. And if I'm not taking these 100 rupees today, but I'm postponing this for, that is, I will take it after a year, same 100 rupees, then in that case, there is a possibility that tomorrow may never come. There's a big risk in that. Or my consumption, which I could have done today, have to be also be postponed because I don't have the money also. And thirdly, if I had the money, I would have invested it. I could have got some more amount of money. But unfortunately, that money is not with me. I will get that money after a year. And therefore, I missed upon these two opportunities. Besides, there's a big risk. Now, that's the reason why 100 rupees today and 100 rupees tomorrow cannot be the same amount. Then the question comes, how much amount of return should I expect from that 100 rupees? Now, there are broadly two things. First, what is called as a risk-free rate. Now, what I mean by risk-free rate, let's assume if I would have 100 rupees today, I would have kept that money in saving bank account. That means even at a 4% interest or a 3% interest in a saving bank account, I would not have consumed anything. I would have even not invested anything anywhere. But even then, that 100 rupees in a 4% saving bank account would have gone to 104, which is without taking any risk. So I'm not taking any risk. I've just kept, and I was assuming saving bank account per se is a risk-free investment option, a risk-free return. That means without taking any risk, my 100 rupees would have gone to 104. On the contrary, had I would have invested anywhere else, then this 100, instead of going to 104, might have become 108 or 110. And that extra, but obvious, I would have taken certain risk. Therefore, what my required rate of return will be based upon how much, what is the risk-free rate which I'm getting without taking any risk. And then if I'm investing somewhere else, I want some extra more than what risk-free return is. Therefore, my required rate of return on my money will be the risk-free rate plus the risk premium. So more risk I will, if I'm taking more risk here, I should desire more return also. So my required rate of return will be a sum total of risk-free rate and a risk premium. Which means what? Which means, let's assume I have a choice that investor taking 100 rupees today or after 1 year. So after 1 year, first of all, let me be very clear, 100 rupees today and 100 rupees 1 year after, they are not the same in the real term. They are not comparable. I have to make it comparable. And it is therefore necessary to adjust this 100 rupees today and 100 rupees tomorrow, and the cash flows, even though nominal amount it remains the same, that is 100 today and 100 rupees tomorrow, the nominal value may look out to be same, but actually it is not same. I need to adjust these two values. Either I have to adjust this value or I have to adjust this value to make it comparable. As I discussed, because this 100 rupees had I would have today, I would have earned more amount of money. And therefore, let's assume if my required rate of stay is 10%, as I mentioned, 10% is how have I got 10%? I've got 10% because I've seen, possibly I can say that my risk-free return is, let's assume, 6%. Let's say bank FD is giving me, and I would have invested somewhere else, maybe in some businesses, maybe in somewhere else, but I would have got 4% extra. Therefore, I'm presuming that my required rate of return is 10%, which means what? Had I would have 100 rupees today, I would have made it 110 after a year. So the 100 rupees today would have become 110 after a year. Therefore, if I'm presuming that my required return is 10%, which means what? The 100 rupees today, the future value of this 100 rupees today, after a year, if a 10% required return is, will be 110. I could have said like this. So what I'm doing it, I'm converting this 100 into the future value, which is 110. Or if I'm getting 110 rupees after a year, today its present value will be rupees 100. So if I as the 100 rupees today is the present value of 110 after a year at 10%. So what do you mean by this? Let's assume if I have foregone taking 100 rupees today and my preference rate is 10%. Then if I am getting more than 110 rupees, then I'm making it's favorable for me. And if I'm getting less than 110 rupees, it is not favorable for me. So the comparing value is not 100 and 100. The comparing value is 100 rupees today and 110 tomorrow. That is how I compare it. And that's the reason why, even though the nominal sense it remains the same, but the real 100 rupees today is equal to 110 tomorrow if my preference rate is 10% per annum return. And this is what is an important concept of time value of money, and we have to adjust the cash flows accordingly. Now, in this, we need to do adjustments, and there are two ways of doing the adjustment. First is compounding. So 100 rupees have compounded and growth to 110 rupees at the rate of 10% per annum. So it has been compounded. This money has grown from 100 to 110. I could have said this statement like this: 110 rupees received tomorrow after a year is discounted for today's value at 100 rupees. So when I say discounting, I'm trying to calculate the present value when the future is given to me. So this is my future value, this is my present value. So future value 110 is given to me, I'm trying to find the present value. So this is called discounting phenomena. Whereas present value is given to me, this is 100 rupees is given to me, and I'm trying to calculate the future value, and that is what is happening. It's called compounding. So compounding and discounting are two opposites. So compounding, the value increases from present to future, the value increases. Why the value increases? Because there's a preference rate of some rate is there, in this example 10%. Whereas discounting, the value falls down because here 110 rupees you are getting after a year. So let me draw a timeline which will keep on coming. This 0 at the time 0, this was 100. At the end of 1 year, this has become 110. So the 100 rupees has grown, compounded to 110 after 1 year. Or I can say this is compounding phenomena happening. Or I can say 110, the present value has discounted to 100 rupees, and this is discounting value. So I hope we are able to understand the concept of compounding and discounting. So compounding means you are given the value today, and I'm trying to find what it will grow after a certain point of time. And that is I'm given present value. This is present value, and I'm trying to find the future value. This is a future value. I'm trying to find this out. Whereas when I'm saying discounting phenomena, I know the values of future, and now I want to find the value of today, and that is called the discounting phenomena. So this is the starting concepts of time value of money. We'll continue this in our next sessions also.